Welcome, everybody. I'm Geoff Dohrmann, the Chairman and CEO of Institutional Real Estate, Inc., and we're pleased to provide you with our quarterly ODCE Fund Index update. This is for fourth quarter 2025. The title is 2025 in Review and What's Next. As always, we'll be recording this, so you'll have the opportunity to get not just a copy of the slides, but a copy of the recording. So if you have to leave early, check out early, don't worry, you won't miss anything because we'll provide you with the recording so you can see the whole event. You might ask, why are we doing this? Well, most institutions benchmark to something, and the majority of them benchmark to ODCE. And there's a lot that goes on behind the numbers that isn't reflected just completely in the annual release or the quarterly release. So we thought it'd be helpful to provide some context. The other reason we're doing it is increasingly private wealth advisors are recommending alternative investment programs to their clients. And one of those alternative investment programs is real estate. And it's hard to find a good benchmark that you can use to benchmark how people are doing. They have to make some adjustments. The fees for programs that are distributed in the private wealth advisory market tend to be a little bit higher, front-end loads, things of that nature that don't exist in institutions. The practices tend to be a little different. There tends to be a lot more supporting the dividend than there is in the institutional market, although there's some of that in the institutional market. So you have to make some adjustments, but at least here you have a useful benchmark to help you understand how real estate and the underlying investments in these programs are actually performing. We like to make this interactive, but because we've got so many different participants signed up, we can't take live questions. But if you have a question, we'll do our best to answer it. The best way to do that is at the bottom of your screen, there's a Q&A icon. Just click on that, enter your questions. We'll pick them up and make sure that they get posed to Garrett. Usually we're able to answer all the questions that are raised. So don't be bashful. If you have a question, you want to get something specific answered, ask and it shall be responded to. Again, for those of you joining late, we're going to be recording this session as always, and you'll get a link to download the recording and the slides. So you don't have to scribble like crazy. You can really pay attention to what Garrett's going to be telling you. Also, I should note that we've already got the next sessions lined up, so you might want to mark your calendars. They're always at 1 o'clock Eastern time. The next one's going to be on June 16th. And then in the fall, September 22nd, and then in early winter, December 10th. So again, June 16th, September 22nd, and December 10th. So without further ado, allow me to introduce our presenter, Garrett Zdolshek, who's the portfolio manager for IDR's ODCE Index Fund Series. They have currently two different fund offerings. One is for institutional investors, and the other one run by Accordant for accredited investors. And Garrett is probably the world's expert when it comes to ODCE funds because that's all he does, is focus exclusively on investing in the ODCE space. Garrett?
Jeff, thanks for having me as always. Looking forward to the conversation. As you mentioned, anyone with questions, please let us know. That's where we develop kind of the ideas and the materials that we walk through based on your questions. So anytime you have questions, feel free to send them now or even after. Really appreciate those of you that send an email afterwards and with more questions or requests for the information. So I think we'll typically follow the same agenda that we always do. I'll pull up my screen here. So as usual, the agenda, we'll talk about the market overview, ODCE update. This is for year end, but we'll certainly touch on what we're seeing real time in the market, what we're expecting from 1Q. The fundamentals, what is driving return or lack thereof in ODCE. And then as always, capital flows. Where is capital coming and going? And to some extent, why as well, I think. So we always start with the market update. I'll just mention maybe the year's been off to a really busy start. It starts, in my mind, Jeff, with IREI in Southern California in January. Lots of attendees talking about the market. I will say I think the optimism is higher than it's ever been on this year being the year for real estate again. That returns, outlook for returns is coming back. I think investors have allocation again for real estate. They're generally, in our conversations, appears either at or below, and more seem to be below their target real estate allocation. But I think the difficult part is where to invest at the moment. Where are the returns going to come from? It's kind of been a year last year of kind of, I think, promises that real estate is bottom, returns are coming back. And while they were positive, they were very low and slow to materialize. So I think, as we go into 2026, we should be on the lookout for the trend of, kind of some momentum. Are we seeing some return come back? And specifically, where does that return come from? So we'll talk more about that as we go through the fundamentals. So without further ado, maybe the ODCE Index overall, and the arrows are a 1-year change, is really pretty flat. The leverage is almost static. Number of funds has not changed. Occupancy is flat, slightly down, and a few more properties have been sold than bought over the year, but again, pretty static. From a property type perspective, too, it's really been pretty static. I think a lot of the big momentum change around more industrial, less office has slowed. Seeing retail actually start to slightly tick up for the first time, and of course, the alternative self-storage and other continues to increase. The West is typically growing when we look back. So the first time we're seeing a little bit of a decline in the West, maybe driven by some Southern Cal industrial, probably. East is slightly up with that, and South and Midwest are pretty flat as well. I talk a lot about this, and I've shown this for a while, but the sector change in terms of the industrial and residential growth does seem to be slowing, if not slightly tapering off. First time we've seen industrial slightly taper off in a while. Resi keeps growing to a degree. Certainly office continues to fall, and we'll expect to see that, although probably not at the same pace we saw over the last 3 years. I'll also note retail, slight increase. We haven't seen that in a while. So a little tick up in retail, especially the grocery anchored sector, seems to be pretty attractive and have a lot of momentum from return given the performance over the last year or so. I mentioned performance and kind of that slow return to performance. So the past year, the total return at 2.9% is certainly well below average, and a disappointing, I think, total overall return in a portfolio. But notice, that included a little bit of value decline again. That negative appreciation certainly was slowing the total return, and then the income, net income, was again pretty flat from, especially when you look at the 3-year, not growing a lot quite yet. So overall, I think it was a slow total return. We kind of view that as also the opportunity at the moment. When, I talked about asset allocation, the ODCE Index, has been slow to come off the bottom, whereas REITs are about price similar. So public markets and private markets, have been largely bopping around the bottom with each other. But that indicates, I think, they view value similarly at this point.
Garrett, we have a question going back 2 slides from Dan Shelley. He says, any anecdote on what is driving the growth in other, i.e. sectors like senior housing or data centers, and is it coming from appreciation or acquisitions?
Sure. So I think it's both, and it's all of the above. If we look at transactions, we can take a look and we can look at acquisitions and see that. So that 12% is the retail and land is at the bottom there. But I think as we look, self-storage was a big part of transactions over the last quarter and probably over the last year. Residential is the vast majority of that acquisition, and now resi account with the new NCREIF methodology of allocating sectors. There's a lot of other sectors within residential now, right? Like senior housing, resi is virtually all housing. So I think we have to look at like what was in that residential that primarily drove that, but generally it's been traditional apartments still. We do see other growing, and we see that growing also from data centers. It's been the best performing sector, so I'll talk more about that. But I think you have both more acquisition and more value growth. With that said, things like life science continue to be in the negative return side of the equation as well. We'll talk more about the returns though from the other sectors in a little bit here. So I mentioned, and just to finish up on asset allocation, I mentioned the public markets now, certainly in the last week or two, public markets are selling off a little bit from here, but all-time highs, a lot of capital appreciation in the public markets has also eased the pressure of allocation for the private markets, especially real estate with values down and public market returns up. We're starting to see that kind of rotation, from overweight asset classes to underweight asset classes. I think too, from a long-term perspective, I found this pretty interesting. The total annualized return over 15 years is still really pretty attractive, 6.5%. I think if we look at that return over that time frame, pretty strong, especially when you consider the volatility and the lack of drawdown, right, in the portfolio. So still, real estate is certainly a very resilient piece of a portfolio. We expect it to be between stocks and bonds, and we continue to see it that way. Certainly at the bottom of the cycle, we'll see the returns a little lower. So we expect that circle to kind of start moving up here, and building its place in the portfolio again. I mentioned that inflection point and values coming back. I think it's a well-trodden path that we believe, and I think a lot of people believe real estate is at the bottom from a valuation perspective. It's just how long does it take to pick up off that bottom? We are well into positive return over the 1 year. It's just a lackluster positive return, which is I think slowing down some of that excitement. And certainly each year. Last year, we had the tariff conversation in 1Q. Obviously, this year, we have the war conversation in 1Q. So it's been a little hard to get off to a really strong start momentum-wise, but we're certainly seeing that recovery at the asset level. From a drawdown perspective, again, kind of 8 quarters of drawdown. Right in between what we saw in the 90s, which was more prolonged and maybe a little less steep, versus the GFC. I think there's probably a lot of conversation that, hey, at the very, very bottom or at the maximum distress, ODCE might have been, arguably probably less liquid and more down than it is. At the same time, I think, we'll probably undercorrect a little bit on both sides, right? Won't have the pickup if we had corrected a little harder like the GFC. So maybe we don't have as strong of a recovery. And I think that's playing out, on the right-hand side is exactly what we're seeing is The GFC values were not necessarily supported, they were just down. Whereas this time around, it's taken a little longer to get that recovery going because the values didn't correct as steeply. I think we're also seeing that recovery take shape in terms of the volatility of performance between individual portfolios or individual funds in the Odyssey. You can see when we go through these cycles, we generally do have some outliers both on the top and bottom as everyone's trying to figure out pricing and valuation. Some maybe a little bit more early and a little more aggressive than others. But that naturally just kind of plays out over multiple quarter cycle. It makes it incredibly hard to truly, I think, compare performance among managers while we're in the middle of the cycle. I think it becomes clear a year out kind of where performance ended up. But while we're in the middle of these cycles, it's, I think we always kind of say, like, don't rush to judgment on track record, just looking back 1 year, 3 years, because individual quarters can have a huge impact. We really kind of want to see the entire cycle play out here. So it's normal to see these, we saw this in the GFC. It's kind of normal to see these bigger outliers here and there. But it seems like that's coming back into a narrower spread as people kind of coalesce around pricing and valuations. I think the other very interesting thing about this cycle versus the GFC is in the financial crisis, the return dispersion of the underlying funds was very high. As you would expect, more volatility, more return dispersion. So the green line is the performance of the best, trailing 1 year performance of the best Odyssey fund versus the worst Odyssey fund. But also notice that blue line, the property type dispersion was really very low and remained below average. So a lot of top line performance dispersion, but not a lot of distinguishment between what asset class you own, whether it was office or retail, everything kind of was down. This time around, you can see that the green line certainly spiked almost near GFC type of dispersion, but the blue line went even above that. And so the sectors were really just the top line sector exposure was the driver of performance, which again, I think is one aspect of portfolio management, getting allocations, top down correct. But it makes it then harder to see through that bottom up value creation, like how good was necessarily the manager at driving performance at the asset level, irrespective of the type. I think it's encouraging to see that blue line come down. It's down around historical average, a little below that today. And again, I think that's another sign of the recovery coming into place with not only the fund divergence coming down, but also the sector divergence. As mentioned, that was largely driven by sector, property type performance. You can see apartment, continues to be kind of that Odyssey proxy, very close performance between apartment and Odyssey, although apartment is a very perceived attractive sector, it seems. A lot of people talking about I want apartment and industrial exposure, but yet apartments priced very similarly. On the higher end, you can see retail and office price in that mid-5 cap rate today. We get a lot of questions like, shouldn't that cap rate be higher? And at some point, I think cap rate doesn't fully explain the valuation when you have a lot of vacancy. Values are down to the point where maybe some assets are just more land value than anything. A cap rate doesn't tell you a lot at that point. So I think it's a directional view, but you can see cap rates have really come down just because occupancy and cash flows have come down, not because values have gone up from the higher, like closer to 6. Lastly, industrial, again, trending up as rents and leases roll. We expect that cap rate number to kind of continue to roll up as we go through the 26, 27 timeframes. Rents are certainly below peak, but that doesn't necessarily mean that they're below historical lease terms. So signed a lease 5 years ago, you're still probably rolling to a higher rental rate and a significantly higher rental rate. We expect that to continue. From a just asset performance, we look at, what percentage, and this is by count, just how many assets were written up, were flat and down. And again, we see that yellow flat, side expanding and the decrease in asset values. Again, the red coming down as well. All, I think, positive signs that, we're finding that valuation equilibrium on the buy and sell side. From a drivers of performance, and I know some of these bars can be a little small when the return's a little small, but again, you can see really the residential and industrial driving performance. But I think overall what's interesting is, and this is unlevered, but what I think is interesting is it's showing, effectively all the sectors are now contributing to return again on an unlevered basis. Certainly interest rates moderating, and when I do these webinars, I kind of prepare some comments in advance, and sometimes they become very irrelevant very quickly. So interest rates are one of those that we'll talk more about because we had to redo that even real time today. I see interest rates are, the 10 years up a little higher again. So we'll talk more about that. But unlevered real estate is, performing positively. It's just being dragged a bit by interest rates. I found this pretty interesting. So third quarter in a row in that industrial is underperforming the benchmark. I think it's always hard to say, is this a short-term or long-term trend? Continue to believe this is probably a short-term trend, and a lot driven by Southern California and tariffs and some other things. But 3 quarters in starts to become a trend, I guess. So I found that interesting. I think residential for the first quarter, right? We're seeing residential below the index, and again, other below the index. So I think some of the norms that we've been accustomed to over the last 2 to 3 years are maybe changing slightly here. Office is up, which again is way off the norm when it was practically at the bottom almost every quarter going back to 22. Again, I think that's maybe not a trend and a short term just bounce off the bottom. And again, the retail continues to be a really good performer, coming back to number 2, only behind self-storage. So I think, some of the trends that we've been used to are getting changed a little bit here at the quarter end, and so it'll be more important than ever to kind of continue to pay attention to these cycles and these allocations, as we go into 26. I promised I'd come back to the alternative discussion on performance. So data centers continue to be, and as a reminder, these are unlevered total returns, but data centers continue to be the best performer by far. And if you think about a 20+% unlevered return, add a little bit of leverage, that's incredibly accretive total return. So I think, the momentum in data centers performance continues to be really, really strong. The next few, again, are the alternative subsectors like senior housing, manufactured housing continue to drive really good return, but very small portions of ODCE today. On the other side of the coin, I'll just mention too, we continue to see things like life science be challenged, again, slightly down, but the outlook is just very difficult to see any light at the end of the tunnel still at this point in sectors like that. So maybe we'll take a moment and switch over to the fundamentals and some of the drivers of these performance, and not only past but future. Certainly, the Fed is on everyone's mind, even more so probably with the market volatility. Inflation is certainly becoming a more uncertain conversation again. We were in a nice trend. I think we had a nice handle on where it was going until the war started. Uh, Certainly, this could be a short-term effect or a longer-term effect. I think on our end, we're still looking at this as a more short-term effect with energy in particular. So something to clearly watch really closely. I think there's going to be two camps obviously formed on this, and one's going to be probably well rewarded one way or the other. Other thing I think to note is around that inflation, though, is that the labor market does appear to be weakening a little bit more. Again, with the war, hard to say how that drives some of these fundamentals, but if we continue to see a bit of that weakening on the unemployment rate, and then inflation does remain in check, I think we could see these interest rates move a little bit more. It was going in the right direction, certainly with cap rates flattening out, interest rates coming down, that spread was getting wider. We'll see where that ends up. I think we're also going to see potentially a lot of noise on performance in 1Q just around debt mark to market, which again is short-term impacts, but can create some real noise around short-term performance as well. Again, this market in terms of the cap rate stabilizing was playing out pretty similar to prior sector kind of outlooks. Typically, we see declining interest rates really driving the spread creation between cap rate and interest rate. When we talk about historical spreads, it's usually been, the interest rates decline and create the spread, not the cap rates go up to create the spread. So about 87% of that spread creation is from interest rate movement, not cap rate movement. May need to see a little more cap rate movement this time around. We'll see. But that can certainly be driven by NOI as well, which, again, has, I think, been a slow driver of performance. I'll talk more about that. From a value perspective, though, Green Street was often used and discussed as another view of performance for private assets and an indicator of valuation. I kind of mentioned, maybe ODCE could have been down a little steeper. At the bottom, you see Green Street, public markets went down a little more. But at the same time, valuations today are largely on top of each other. So I think, public and private continue to coalesce around values, which is a very encouraging sign, for the future. I think this is a new chart. One of the things I think that's probably not talked enough about is construction costs and replacement costs. So as we think about valuations today, and certainly replacement costs can be a tough number to come to with older assets, and maybe not as relevant, but with newer assets or relatively new assets, thinking about the cost to build a new asset to compete with that is really relevant. And when we've seen these larger dislocations of valuation versus cost to build, that's again been another sign that we're coming back into equilibrium. So you can see in the prior cycles, we've typically seen about a 27% discount to replacement costs or construction costs. Today, again, I think we're getting down around that number. Construction costs might flatten out for a period of time, like, that we saw a bit in the GFC, but really have never seen them go down. I think that is probably very consistent with the long-term outlook. I think it's hard to envision a place where construction costs go down. So even if they flatten out a bit, I think we're going to continue to see a lack of new supply. And so we're going to have to see the existing supply catch up and make it feasible again to develop apartments and industrial in particular. So it's more of a matter of time than if, I think, whether that, value kind of creation comes back. I think it's Friday, Jeff. It seems like we don't have nearly as many questions on a Friday when everyone's tired, but
Either that or everybody's really depressed. I don't know which.
well, I'm going to get into the positive side of things here. So I mentioned that new supply, it's down 54%, again, because it's very difficult to make new development pencil. So the outlook, right, 24, 25, rent growth was slightly negative. And that's really going to be the return driver of performance going forward, right? We're not going to see a lot of cap rate compression. We're going to need to see returns driven by NOI growth. Now, with low leverage for Odyssey and some, moderate rent growth, even leverage becomes accretive again. And we start to envision a market, that gets us closer to that 7-8% total return. I think the question is how fast does this rent growth pick up? So 25 was negative. We just started seeing some positive rent growth again in the fourth quarter. Hopefully that momentum continues to take place. It feels like industrial and apartment in particular is growing. So I think it might feel a little slow again, but once these kind of rent growth numbers kind of form, that should drive value from a valuation perspective as well.
Okay, Garrett, we have a comment from someone who said, taking notes on my end, and you guys are moving quite fast. It's a bit hard to ask questions as you flip through. Can you please slow down just a bit? And somebody else had asked, can I get a copy of the slides? Well, we announced that in the beginning, but yes, we're going to provide a link to allow you to download the slides. And you'll also get a link to download the recording of this. So you don't really have to take notes. You're going to get a recording of it, and you can upload that recording into AI and it'll transcribe it for you.
Sorry I go fast. We have a lot to cover, so want to make sure we get to the end. But yeah, if you have any questions you want to go back to, happy to go back to some of the comments. So I mentioned NOI, Odyssey NOI growth again just started to pick up from the bottom in the fourth quarter. You can see that pick up on the very far right in blue. Again, it's been trailing a little bit behind inflation, which is pretty unusual, I think, from the long term. So as this NOI kind of adjusts, I think we're going to start seeing that value adjust pretty quickly as well. Certainly the reason NOI has been low is a lot of development was completed and came online in the last kind of 2 to 3 years. So short term, probably a supply imbalance to too much supply, but long term, we continue to be pretty optimistic that there's going to be an undersupply over the next 2 to 3 years. Cost of debt, again, is another contributing factor to not only new supply, but just return and the accretiveness of that return. So overall, all debt across Odyssey, the 27% LTV, that debt has an average cost of about 4.5%, which, has been remarkably stable over the last 2 years because the majority of debt, kind of two-thirds, 75%, is fixed rate. So certainly that fixed rate is slowly edging up towards that 4.5. But I think as well, just as encouragingly, that floating rate debt is coming back down off its peak. It's pretty remarkable to think of debt was around 7%, 2 years ago, floating rate debt, and now it's 5.3%. So again, I think capital markets showing, a recovery is in place. It is moving down. It'd be great to see it move down just a little bit more, maybe. But even, at that 4.5, 5% rate, I think, returns will be, or debt will become back accretive to overall return here, in 26 and beyond. So it's just another headwind that's turning into a tailwind. Again, that debt maturity is very staggered and laddered. Very little concern about rolling the debt and how it will mature. So I think it's going to be a very orderly transition here, to this little higher for longer interest rate environment. But even at these little higher rates, debt will help drive return again to a degree. Sorry, so we'll go from here. We'll go to capital flows. And I think we'll start off with, the acquisitions, dispositions. So I think it was interesting looking at year end. Certainly saw a lot more acquisitions. So saw more deals pick up. We'll talk more about Qs, but I think it shows there is some availability of capital again. All the anecdotes we hear from managers and those, on the front lines are that deal flow is picking up, whether it's buying or selling. There's there's a bigger buyer pool for every asset again. It's becoming more competitive, in that, largely cap rates and things like industrial and apartments seem to be flattening, if not edging down again. They're certainly not expanding. So I think that's pretty encouraging. Again, almost $4 billion, $3.5 billion of buying and selling took place, which shows, people are coming to agreement, at least on valuations. So we briefly touched on this. In terms of the sell side, pretty even pie chart to some degree. I think, if you look, office is still a big component, around 21% of the sell side, but not the dominant factor anymore like it was. Interesting to me that industrial was the biggest place that was sold. Again, I think why industrial exposure is leveling off. And then I think on the other side, very interesting to see 63% of that deal flow was apartment.
Question, where does senior housing land here? Seems like a lot of transaction activity not captured here.
Well, this is all the transaction activity in ODCE. And certainly there's a lot of non-core transactions that take place and a lot of non-institutionally owned transactions taking place. So yeah, this is not meant to show you the, total stock bought and sold, given that a lot of it is not core. I think if you look at senior housing, I believe senior housing is still captured in residential today, and for ODCE purposes. We can certainly break it out further, but we try to hit the broad brush here.
And then another question for office, does the disposition data capture both sales to third parties as well as foreclosures, transfer to lenders, those sorts?
It does. We typically see, comments around, foreclosure used as a transfer to lender. These are big core portfolios that are, super underlevered. So it's really just a conversation of, does it make sense to support this asset or not if it has debt on it? And it's a pretty orderly process typically. If it doesn't make sense, it's given back to the lender, pretty easily. So I think that's probably a little different this cycle too than last cycle, where virtually, if any, assets were given back in the GFC, given the shorter and steeper part of the cycle. Everyone just kind of waited it out. in this part of the cycle, I think the fundamentals in office, depending on what you own and where, uh, even with low leverage, the decisions are coming where maybe it just doesn't make sense to own that asset anymore. Unlevered values are down, 40% across the index, but we certainly see assets that are, down 50, 60, 70% from peak value. So depending on the capital structure, we are certainly seeing those assets go back to a degree. Although I'd say it's materially slowed, and places where lenders don't want to own the assets either, those things are getting worked out. From a net flow, so this is, as a reminder, this is all capital flows overall. So distributions include income, dividends, everything going out, including redemptions and sales, everything. And then contributions, again, that includes reinvestment of dividends, new capital coming in, and so any new primary investment. You can see, we continue to see net outflow, more redemptions being paid out as, the markets and as funds have kind of figured out their net outcomes needed from an inflow outflow standpoint. But I point out there is still about $2 billion of capital coming in. Difference is there's $5 billion of capital going out today. So certainly still seeing that net outflow. What this also is not catching, though, are secondary transactions. So we're seeing a very robust secondary market in ODCE and other open-ended core plus funds even. So this does not capture that secondary market, but I would say it's continues to be very robust. It's probably, adding maybe $1 billion a quarter to this or something, maybe $500 million. We continue to, participate in that in a big way. And so while the top line maybe, flows in don't look as big, they're probably a little higher than this when you think about the secondary market as well.
And one person wanted to know, what's the discount in the secondary market for ODCE fund interests?
Sure. So it's a great question, and it's very hard to generalize in that there's some funds that have no execute today, so you can't buy the 4 or 5 funds without an execute today at any price on the secondary market, and so it's zero effectively, right? There's probably a handful of funds that have a very low discount because they're well known or they're perceived attractive for whatever reason. And then there's other funds that have a very high, probably still close to double-digit discount, but very little transaction activity there because most investors just don't want to own it. So the very widespread of what you can buy, what volume you can buy at scale or not at scale, and what the price of that is. So redemptions paid out from the funds, again, getting better from 2025 2Q 3Q. It seems to be stabilizing. I think this will only get better as we go for the next few quarters. And again, it's a very wide range of at the fund level. I mentioned there's probably 5 funds that don't have any Q today. They've paid out. Their capital base is strong, and in fact, they might even have some inflow, so they're buying some assets. So, on one hand, you have some, funds on the front foot again. I think on the other side, you have some funds that continue to have some pretty big Qs, and they're not buying. So, again, those returns may be a little different as well, and impacted by that.
Garrett, what would you say constrains some managers from meeting redemption requests while others are able to? What's the difference? What are the managers that are able to meet redemption requests doing differently, or are their portfolios constructed differently? I mean, what's the deciding factor? Because you would imagine that everybody wants to meet the redemption requests that they can.
Yeah, I think there's a number of pieces to that question, Jeff. So I think one, you have the investment performance, right? Maybe you have portfolios that were built more recently or kind of had a little bit of hindsight benefit that they didn't want to own as much office or retail, so or malls. So maybe it wasn't the let's say they weren't necessarily legacy portfolios. They were more modern looking portfolios today. So the performance has been better. The investors are happy and they're not redeeming. And in fact, there's other investors out there that want more exposure like that, right? So on one hand, you also like, even if you're paying out, if you continue to get new investor redemptions, it almost makes it look like you're standing still. So that's kind of what this is showing. Like the green is two things. It's new investor redemptions and rescissions. So again, you see that there is more kind of redemption coming in. And then on the blue, you have the ODCE fund, like that's really the redemption payout. So they're making progress in that black dot, right? They're paying out, they're making progress on their queues, which I'll go back to that line. But it doesn't feel like they're making as much progress, right? That black dot shows, well, you only reduced my queue effectively by $1 billion, when in reality, $3 billion was paid out, but $2 billion of new came in. So I think it's often maybe misappreciated how much redemption gets paid out. It's just like we didn't always understand either that so much new redemption comes in every quarter. You kind of think, well, if you're going to put a redemption in, didn't you do it 2 years ago? And that's not necessarily the case.
And somebody's asking, has there been any pressure from investors to force ODCE managers to generate liquidity within X number of quarters post redemption request?
Yeah, that's a good question. I would say there's a couple things to that. So one, redemptions are coming down, and we're effectively 11% of NAV is in redemption queue today. So on one hand,
What was it at peak?
yeah, so it was 19% at peak. So we're getting close to half of it getting paid down or half of it going away. So like, again, let's put that in perspective. 11% of ODCE holders want capital back today. I would also say there's some percentage of that remaining in the queue to get some more liquidity maybe, or a little more, but probably doesn't want everything. So, you can rescind your redemption as well. I think there's a percentage of that will ultimately rescind. And we see that getting better. So now just rough numbers. Let's say 10% want to still redeem and get paid back. That effectively means 90% of what's in there today wants to stay or wants return out of real estate. So I think there is a practical and a very fine line between, creating liquidity for the people who want redemption, but also maintaining value and doing the right thing for the 90% that want the manager to generate return, right? So, at what point do you sacrifice return for liquidity? And that's why there is no force mechanism to do it. It's largely most people want to stay and most people want the manager to do what's right for the portfolio in the long term. So I think, on one hand, it's kind of the correct model. On the other, certainly I think it's going to be a bigger part of due diligence going forward of like when people do want money, have you really provided liquidity and in what time frames? And so I think it's going to be a much bigger part of the due diligence kind of conversation on the buy side going forward as well. And so as like one LP put it in a conference or a LPAC, something is way different than nothing, right? Like making the effort, and even if they're small redemptions at certain points in time, providing something is really important. And that's generally what we see happening is most funds are at least providing something.
And there's a question, any idea of volume of shadow queue that exists due to fee rebate programs on non-redeeming shares? In other words, where the manager's offering a lower fee to people that stay in.
Yeah, look, I think it's relatively small, candidly, at the end of the day. I think it's kind of like that rescission point too, right? Where I think some investors will probably rescind their redemptions. Others, when the fee rebates kind of roll off, they might maybe reduce a bit. But, by and large, I think if you're accepting these fee rebate proposals, it seems like we've been through the worst. Now is a pretty poor time to, get out of real estate given where valuations are at this point.
And this is more of a recommendation to those people that are marketing these funds. The participant says it's important for investors to know that it may take 12 to 18 months for redemption payout. In other words, it's important to create realistic expectations.
Yeah, look, I mean, the word in the private wealth market is semi-liquid, right? And I mean, I saw something kind of funny the other day, like to an article, a comment to an article that was kind of talking about how, these semi-liquid structures are, not fully meeting all the redemption requests in the quarter they're due, right? Now they have different terminology for it, but it's effectively the same thing. And the comment was like, wait, you're telling me my semi-liquid investment is semi-liquid? Like they are not stocks. You can't necessarily redeem in the day you want it. And so it is part of the consideration that there, will be a potential lag for liquidity. And again, I think it's going to be a bigger part of due diligence. It's a bigger part of conversations around portfolio construction. But I think return and liquidity have to be managed hand in hand. So maybe we'll end it, Jeff, on just, kind of the Q slide. I think, progress is being made. Last year, you see that little blip, kind of as that red line was coming down very evenly, and then it kind of flattened out there for a quarter. That was last year's tariff announcement. It certainly had a effect on the market pausing kind of all the way around in 1Q. I think we built up some momentum again. And now we're back into 1Q of 2026 talking about a war, right? So we'll see how long it lasts. We'll see how much of a true disruption it causes or doesn't cause. And certainly investors have a lot of different opinions on that, wide-ranging opinions. So I think we're going to certainly see a period of pausing and volatility again. But hopefully we also see, some of these NOIs come back, and with values largely at the bottom, we hopefully start to see some, better return generation, probably into 2Q and 3Q, of this year.
Okay. So what I'm hearing is that construction costs are high and that's putting a damper on new construction, which will allow the markets to absorb any excess supply, that the direction seems to be towards positive recovery, assuming no further disruption as a result of the wars and no further expansion of the war, that the outlook is relatively positive, probably more positive than it's been in a long time, which is, I think, good news. So thank you, Garrett, for your team and your work in putting this together. I know it's a lot of work to pull all this data together and then to think about it and be able to try to communicate to people what the meaning is. Thank you to all of you who tuned in, and thank you to those of you who post questions. It's always great when people are interacting and letting us know what they're most interested in getting their questions answered. And again, we've got another program coming up. Hope you'll tune in for that. And we will be sending you links to download the slides, download the recording, and I think we can probably also have the recording transcribed and get that to you too. So you don't have to worry so much about note taking or whether you got everything. Okay. Thanks so much for tuning in. We really appreciate your support. We appreciate your loyalty and look forward to continuing to be of service.
Great seeing y'all. Thank you.